there is so-called blood in the street. It's a crude saying, but it means when markets are deeply into bear territory. You should have, there's a cycle of fear and greed, and both are healthy. The fear should occur at the top of cycles, taking profits, and the so-called greed part of that dynamic should occur at the bottom of cycles. And surely after maybe an 80% reduction in, on average in our various strategies, we are closer to the bottom, certainly, than to the top, as we were in February 2021. In terms of our strategies, we, during downturns, concentrate towards our highest conviction names. And so we have been doing that now for nearly 2 years. And the history would suggest that that concentration strategy plays out very well in the subsequent rebounds. And we do think this rebound will be quite powerful. This year has been the most difficult year of my career, worse than 08-09, and I would venture to say that it has been the most difficult year of many investors' careers. The only thing that worked this year was energy. It's up almost 50%. And many people are asking us, why don't we diversify into energy since it's working? Well, the reason for that is we think it will stop working. If our forecasts for electric vehicles and autonomous taxi platforms are correct, then oil demand could drop by roughly 30%, 30 million barrels a day during the next 5 to 10 years. And we believe that demand destruction has already started. It looks like oil demand peaked in 2019, and we're still in the process of peaking out, I would say, in the 100 million barrels per day range. But we think the resolution of that basing period here is going to be down. So we wouldn't be investing in energy, and we think the indexes that have rebalanced and now are including more energy are mistaken, and those investments, that rebalancing will not work out. Now, another question. You have been buying more Tesla and other stocks during the downturn, and yet the prices have fallen further, and our performance decline has worsened. With interest rates and prices fluctuating so widely, and in this case they probably mean increasing, will an investment focus on innovation work? Well, we believe that the leading indicator, correctly, is inflation, and it has peaked. The inflation rate has peaked. Almost every measure of inflation has peaked. Most of those metrics peaking out in March or June of this year, in the first or the second quarter. So typically, that's a good thing for innovation. But as I just mentioned, I think the market is so skittish and has been so terrorized by the most rapid increase in interest rates ever. We have never seen an 18-fold increase in interest rates within 1 year. It has truly terrorized the markets. And I think that the fear is palpable. In fact, I think according to the Bank of America recent surveys of fund managers and advisors, it's probably the advisors, we haven't seen this amount of cash on the sidelines since I think it was 2006, maybe even 2001. I do know also the same survey shows that the put to call ratio in the US market, meaning those short relative to those long put calls, is at 1.5 now, and it has not been that high since 2001. So we have an incredible amount of fear in the market, and that actually is the best time to average into these markets. I remember in late 20, early 21, we could do no wrong. Anything we said was gospel at the time, and I knew that wasn't right. And at the time, I remember saying, keep some powder dry. It is for these moments, or averaging down throughout a period like this, that one keeps the powder dry. This period seems to be the flip side of the late 90s. The late 90s was an irrational increase in tech stocks, appreciation in tech stocks. And it was incorrect. The technologies were not ready. And even if they were close to being ready, the costs were way too high. So technology's not ready. We didn't get the cloud till 2006. We didn't get the big breakthrough in AI, deep learning, until 2012. The cost for DNA sequencing, $2.7 billion for one genome back in 2003. That number is down to $500 now. We are ready for prime time, and yet investors are doing the opposite of what they did during the late 90s. They are running away, running for the hills, running for their benchmarks, and we think that innovation is going to pose a problem for the benchmarks. So you bet we think innovation is going to work. We think it's going to work in a big way. We are ready for prime time for these 5 innovation platforms. Another question. Investors seem hesitant to invest now for long-term growth, given supply chain disruptions and the economic downturn caused by rising interest rates. Why do we believe that now is a once-in-a-century investment opportunity? Well, a couple of reasons. Innovation solves problems. And we have a lot more problems now, even more than during COVID. We have corporations now experiencing margin pressure. And we have individuals, consumers, perhaps worrying about their jobs. And when we get into a period like this, businesses and consumers are willing to change the way they do things. And they embrace innovative solutions to their problems. Now, this once in a century is not an understatement. We have not seen more innovation platforms evolve at the same time ever. The closest is about 100 years ago: telephone, electricity, and automobile. Interestingly, back then, we were just getting over a pandemic, the Spanish flu, and over a war, World War I. And at the same time, we were experiencing incredible innovation. And so very similar dynamics. And what happened? Inflation peaked in June of 1920 at 24%. And within 1 year, it was minus 15%. We think we're going to experience a mini version of that during the next year. And then what happened? We launched into the roaring 20s when the stock market had, I believe it was a compound annual rate of returns of 25% for the next 8 years. The roaring 20s, we think we have a setup here for the roaring 20s, and it is all around innovation.